April read on Consumer Price Index. And believe me, if you're standing, I recommend you sit down.
During this time of reopening, we are likely to see some upward pressure on prices.
The Labor Department reported Thursday that consumer prices jumped 5% over the past year.
Yeah, inflation soared to its highest level in over a decade in April.
That over the next 2-3 years, we could easily have 20% inflation.
Welcome back to the Dr. A Show, where we talk about economics and how it impacts you. If you're reading the news, then you know that inflation concerns are taking center stage, and it's hard to avoid the discussion about prices. In a previous video, I discussed the hot housing market, which is closely related to today's conversation about inflation. Inflation's going up. The increased annual headline CPI rate was the fastest since 2008. The monthly gain in core inflation was the largest since 1981. What are the possible reasons for this increase in inflation? Well, they range from supply shocks, supply chain issues, to the recent stimulus package passed in 2020 and 2021. Some fear that it might be causing the economy to overheat. So what does this mean to you? Should you be worried about the recent inflation numbers? Today, I want to talk about the growing inflation numbers. We will discuss what is happening, why it's happening, what to expect in the future, and how it will impact your bottom line. If you want to learn more about inflation itself and how it's calculated, check out my other series of videos where I discuss how inflation is actually measured. So why are we seeing inflation? Spending after the pandemic has something to do with it. A year ago, spending drastically decreased. Everyone was stuck at home, not going out, and not spending. Now, with COVID cases decreasing and increasing vaccination numbers, people are finally able to go back out and start spending. This sudden spending shock is pushing prices up. This change in spending is going to complicate things. Year-over-year comparisons are going to be distorted for a few months because of this pandemic's impact. The other reason is supply chain shocks. The pandemic also slowed down production of goods and services over the past year. Firms have struggled to revive these supply chains. There is a shortage of items in the market, which is driving prices up. We're seeing this in car manufacturing specifically. The lack of semiconductor and chip shortage has pushed car prices up, especially in the second-hand market, where everyone is flocking since new car production has stalled. Some economists believe that the elevated prices, because of this increase in demand and supply side lag, are only temporary. So they're calling this recent 4.2% increase in prices as transitory inflation. For that reason, Federal Reserve policymakers are dismissing the current round of numbers as transitory, with expectations of inflation settling down later this year around the 2% range targeted by the central bank. Others are more worried about inflation because they believe that inflation will last longer than the Federal Reserve predicts, because it's going to be driven by the recent stimulus packages and expansionary monetary policy. The money that the government and central banks is pumping into the economy can cause a positive output gap, where spending in the economy is growing too fast due to the extra liquidity in the market. This has the potential of causing runaway inflation if not controlled in time. Look, it's not clear if inflation's here to stay or if it's temporary. Most economists, including Fed Chair Jerome Powell, believe that it will pass. After the latest Fed meeting, he said, and I quote here, "Our expectations is these high inflation readings now will abate." The Federal Reserve has raised its expectations for 2021 inflation to be around 3.4%, but expected to return down to their target inflation rate of 2%. So the question is, what does this mean to you? The price increase you are seeing today are in response to the falling prices of last year. We saw this in energy markets. Oil fell sharply last year as market demand fell, and now it's moving back up. Here's a graph of the Brent European oil prices. Current market prices are lower than where they were in 2018, but much higher than where they were in Q2 of 2020. As I mentioned in the recent housing video, the housing market is hot and housing costs are a big part of the consumer price index. As the housing market cools, that should also reduce inflationary pressure. In the short run, we will see increasing costs relative to a year ago. Some increases may stay to make it into long-term contracts. We are seeing average wages finally start to pick up, which is actually a really good thing. Wage growth has been low in the US since the 1980s. Another thing to talk about is inflation helps redistribute wealth. When there's unanticipated inflation, there's a redistribution between lenders and borrowers. Lenders are hurt by unanticipated inflation because the money they get paid back has less purchasing power than the money they loaned out. Borrowers benefit because the money they pay back is worth less than the money they borrowed. So borrowers might benefit from this inflation. Over the next several months, as we return to normal and supply chains are connected again, as work hours pick up, as we start to move away from fears of COVID breakouts, we will start to see supply increase. And then we will know if inflation is transitory or if it'll be here for a while.